According to Marco Dunand, CEO of Mercuria, one of the largest trading firms in the world, OPEC and the OPEC Plus group may be forced to make further production cutbacks if they wish to balance the market due to slowing growth in oil demand and higher than expected U.S. oil production. High growth in U.S. oil production is beneficial when China's demand rises by 1 million barrels per year. However, demand in China and globally as a whole is slowing and is expected to increase by 1.5 million barrels per day this year, Dunand said to Reuters on the fringes of the World Economic Forum, which is now taking place in Davos, Switzerland. The CEO of Mercuria anticipates slower increase in the world's oil demand than does OPEC, which stated in its most recent monthly report on Wednesday that demand will rise by 2.2 million barrels per day this year and by an additional robust 1.8 million barrels per day the following year. Despite the fact that the U.S. surprised the market last year by growing its oil output faster than anticipated, Mercuria's Dunand believes that growth may be slowed by the current shale patch consolidation effort. Over the past year, U.S. oil production growth was underestimated. However, due to significant industry consolidation and cost-cutting measures, it would most likely slow down, he told Reuters. If the assumption of slower demand materializes, OPEC will be in a better position to further maintain prices and the market equilibrium by making deeper cutbacks. Dunand told Reuters that the Saudis might need to go further with production cuts if they want to control the price. According to analysts, the supply and demand situation for oil appears to be somewhat balanced or somewhat in excess this quarter. They predict that a spike in demand during the second and third quarters would tighten the market and maybe raise prices. A lot will depend on the supply strategies of OPEC+. Further production reductions for the first quarter of 2024 have been announced by the alliance. If the group decides to reverse those cuts, in whole or in part, after March, supply should more than be able to keep up with the growth in demand, especially since non-OPEC+ producers' oil production, led by the United States, Brazil, and Canada, is also predicted to keep rising. According to experts at Rapidon Energy Group last month, OPEC+ may need to continue closely controlling its supply to the market for the next 5 years in order to prevent a collapse in oil prices due to rising production from the US and other non-OPEC+ oil suppliers. In the past, oil prices have increased at the slightest hint of a crisis in the Middle East. However, it was back then. Oil prices are still the same as they were a month ago, despite the fact that the conflict between Israel and Hamas is intensifying and tankers and container ships are departing the Red Sea. Despite a real interruption in the U.S. supply chain, there was a significant decline in North Dakota's daily crude oil production this week, ranging from 650,000 to 700,000 barrels per day. However, it appears that this drop has had little impact at all on the price of oil internationally, since everyone anticipates that this manufacturing will resume as soon as the current cold snap passes. Furthermore, it appears that everyone anticipates that this year's growth in oil consumption will be roughly equal to the growth in production in the United States, Brazil, and Guyana. John Kemp of Reuters authored a recent column. And for this reason, despite the possibility of a significant supply disruption as well as one that has already occurred, oil prices are not rising. Meanwhile, economic data from China, the world's largest demand generator, seems to have let us down once more, despite indicating a 5.2% growth rate for the fourth quarter. Under any other circumstances, this result should be highly outstanding in terms of economic growth rates, particularly when contrasted to certain advanced economies that saw a decline in GDP last year. However, aspirations seem to be higher than what reality can provide when it comes to China. The disappointment that follows either lowers or maintains oil prices. Despite the fact that China has announced a record-breaking pace of refinery throughput for 2023. Even if tankers and container ships are choosing the far longer route around Africa and the Cape of Good Hope instead of the Red Sea and the Suez Canal, oil prices are not rising. Oil prices ought to have increased as a result of the swap because increased fuel consumption is an inevitable outcome. However, nobody seems to be considering it, focusing instead on U.S. supply and China's demand. Chevron's CEOs expressed surprise that West Texas Intermediate was not trading at a higher price, stating that risks are very real in the Red Sea. Presumably, he is not the only one taken aback. According to Mike Veerth, CNBC this week, I think you could see things change very rapidly if it were cut off because so much of the world's oil flows through that region. However, it appears that the majority of participants in the oil market have either discounted this danger as unlikely or, as Kemp of Reuters notes, have chosen not to begin panicking over prices. And the reason for this is that there is backup supply from OPEC itself, and the chance of a significant supply disruption in the Middle East really occurring is low. Analysts often support the notion that OPEC has spare capacity. In fact, the aggregate spare capacity of OPEC and its allies in OPEC Plus is more than 4 million barrels per day. However, until these producing states choose to use it, this is completely irrelevant. However, at the moment, they are acting in the exact opposite way. By decreasing real production, they are essentially raising their spare capacity. And they won't veer off course until prices increase, and even then, only in the event that there is an interruption in the supply. Meanwhile, given their purpose, demand seems to be anyone's guess. OPEC projects a sharp increase in oil demand, reaching 1.85 million barrels per day by 2024. According to its own projections, the International Energy Agency anticipates that this trend will slow down as the energy shift picks up steam and EV sales soar. In the past few years, OPEC has historically tracked real demand trends more closely than the IEA. However, the market is also ignoring this. The market is already bracing itself for another disappointing GDP data from China. As OPEC anticipates robust oil demand this year, U.S. stockpiles are declining, and the potential of escalation in the Middle East remains high. Crude oil prices were expected to end the week higher. Supported by these elements, the benchmark saw some rises earlier this week. However, these gains were offset by the International Energy Agency's most recent oil market report, which increased its demand prediction while predicting a stable supply this year. Because of the advances, several analysts predicted that oil would conclude this week at its highest level in 3 weeks. This is just one more example of how difficult the market has become for oil bulls in spite of a plethora of other optimistic developments. These have been counterbalanced, though, by ongoing concerns about monetary policy and economic development, particularly in China. Prices were not affected at all by this week's significant production stoppage in North Dakota, that is, until the Energy Information Administration published its inventory report. According to Vandana Hari of Vanda Insights, it may have been the U.S. crude stock draws that ultimately compelled the market to price in the Bakken outages and, consequently, ascribe a bit more risk premium to the Middle East crisis too. She stated that a Red Sea incident that results in significant loss of life and property, either at sea or on land, may become the tipping point. The unrest in the Middle East has caused a noticeable increase in freight and insurance costs, but Jim Ritterbush, president of Ritterbush & Associates, told Reuters that aside from delaying supplies to Europe and other areas, the oil supply worldwide has not yet been impacted. However, these delays are driving up expenses, and the lengthier trip around Africa will result in a higher demand for gasoline due to the traffic diversion from the Red Sea. The oil merchants have not yet taken this additional demand into account. Following the release of OPEC's most recent monthly report and North Dakota production disruptions due to weather, crude oil prices increased somewhat earlier today. Nevertheless, the price increase was only slight because the IEA predicted weak demand growth this year and the American Petroleum Institute anticipated a gain in oil stocks that economists did not anticipate. OPEC said on Wednesday in its January monthly oil market report that it anticipated an increase in oil demand of 2.25 million barrels per day this year, which would then decline to a still pretty healthy 1.8 million barrels per day in 2025. According to OPEC, the rise in oil demand in 2024 would be mostly driven by the almost 1.7 million BPD growth in non-OECD nations, primarily in China, the Middle East, and India. The most recent Chinese economic data, however, seems to have let oil analysts down, even though it points to rather strong growth. After expanding by 4.9% in the third quarter of 2023, the Chinese economy grew by 5.2% in the fourth quarter. However, the disappointment stemmed from the fact that the result was 0.1% lower than the expectations of Reuters polling economists. Although the outage should only last a few days, the announcement that North Dakota's oil output has decreased by between 650,000 and 700,000 barrels per day had a limited beneficial impact on pricing. However, the International Energy Agency stated that, barring any supply disruptions brought on by geopolitics, it anticipated a well-supplied oil market this year. The president of the IEA, Fatih Birol, stated in Davos that I expect this year a comfortable oil market, a more balanced oil market, if we don't see any major geopolitical surprises. Speaking of surprises, there is no indication that the Middle East conflict will end, as seen by the US's recent round of raids on military sites in Yemen and the joint strikes of Iran and Pakistan. According to IG market strategist Yep Jun Rong, Reuters, Brent oil prices are still largely trapped in a range as they have been for the previous 2 weeks as market participants attempt to balance shifting demand-supply dynamics with ongoing geopolitical tensions. However, ING analysts cited the most recent U.S. retail sales data, which revealed higher than expected numbers and raised concerns about the Fed's monetary policy this year, as unfavorable for oil. As per ING, the sales statistics effectively mitigated the supply issues related to the Middle East. And that's it. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching, and I'll see you in the next one.